Welcome to Chapter 2, Cost Classification, from ACCA Management Accounting. In this session, we're going to understand how different types of costs are defined, how they behave, how businesses track them, and why that matters for control, pricing, budgeting, and decision-making. This chapter is the foundation. If you don't understand cost classification, you can't do costing, budgeting, variance analysis, pricing, CVP, or performance evaluation later. So this is core. Before we start, let's look at what you're expected to be able to do after this chapter. First, cost classification concepts. You should be able to distinguish between cost centers, profit centers, investment centers, and revenue centers. You should be able to explain the difference between production costs and non-production costs. And you should be able to describe the elements that make up production cost and non-production cost. Second, cost analysis and behavior. You should be able to classify costs as direct or indirect, and as fixed or variable, and also identify semi-variable costs and step fixed costs. You should be able to read and interpret cost behavior graphs. You should be able to apply the high-low method to split total cost into fixed and variable parts. And you should be able to explain the linear cost equation, which is y equals a plus bx. Third, responsibility and cost objects. You should be able to explain what a cost object is, what a cost unit is, and what a cost center is. And you should be able to distinguish between the different types of responsibility centers, cost centers, profit centers, investment centers, and revenue centers. And finally, coding and information systems. You should be able to explain how organizations use cost codes to categorize and track transactions consistently. This is exactly what exam questions are built around. Let's begin with, what is cost classification? Definition. Cost classification means grouping costs by common features so that the business can analyze them, control them, and make decisions. In simple words, we put similar costs into buckets to make them easier to understand and manage. Why is that important? Because it directly helps with budgeting, with variance analysis. That means comparing actual versus budget, and performance evaluation, which is judging how well departments and managers are doing. Here, we can see a simple table summarizing the main bases of classification. First basis, function. This means, is the cost related to production or non-production? This type of split is mainly used for reporting and for valuing inventory. Second basis, nature. Here we talk about direct costs versus indirect costs. We use this view for cost control because managers are usually responsible for specific controllable costs. Third basis, behavior. This is fixed cost versus variable cost. This is critical in budgeting and forecasting because it tells us how total cost will move when activity goes up or down. Fourth basis, responsibility. Here we link costs and revenues to responsibility centers. For example, cost centers and profit centers. This is used to measure performance of managers. So already, you can see, the same cost can be looked at in different ways depending on the decision we're making. Now let's talk about responsibility accounting. Responsibility accounting is a system that assigns accountability for results to specific managers. The idea is every part of the business has someone in charge, and that person is measured on the things they can actually control. There are 4 key types of responsibility centers to understand. Number 1, cost center. A cost center manager is responsible only for costs. For example, a production department in a factory. The manager is judged on whether they keep costs within budget. Number 2, revenue center. A revenue center manager is responsible only for revenue. For example, a regional sales office. We judge them on how much revenue they generate. Number 3, profit center. A profit center manager is responsible for both revenue and costs, basically the profit figure. For example, a hotel outlet or specific branch of a store. We ask, are you generating profit? Number 4, investment center. Here the manager is responsible for profit and also the assets used to generate that profit. This is typically a whole division or region. We judge them on return on investment. Are you generating enough profit compared to the assets you're using? This matters because management reporting, targets, and bonuses are designed differently for each type. Next, production and non-production costs. Let's compare the two key categories of cost. Production costs are costs that relate directly to making the product or providing the core service. Examples include direct materials, direct labor, and factory rent. Accounting treatment. Production costs are included in the value of inventory. In other words, they sit on the balance sheet as part of cost of inventory until the goods are sold. Non-production costs are costs that are not part of manufacturing or core production. This includes admin costs, selling costs, distribution costs, and finance costs. These are not included in inventory. Instead, they are treated as period expenses and go straight to the profit or loss statement. This production versus non-production split is extremely important because financial reporting standards, for example IAS 2 inventories, only allow production costs to be capitalized into inventory. Selling and admin costs must be expensed in the period. Now let's zoom in on production cost and break it into elements. There are three standard elements. Material, this is raw materials, components, packaging, anything physically going into the product. Labor, this is wages of staff directly involved in production. Overheads, this is the supporting cost of running production, such as factory rent, factory electricity, machine depreciation, and so on. Here are two key formulas you need to remember. Prime cost equals direct material plus direct labor plus direct expenses. Prime cost is basically the direct, traceable cost of making one unit. Total production cost equals prime cost plus production overheads. So once you add the overheads, you get the full cost of production. You will use these structures in cost cards and product costing questions. Now we list the main types of non-production costs. Administrative costs. These are to run the organization in general. Example, accounting team salaries, HR salaries, office management. Selling costs. These are costs to get the order, to drive sales. Example, advertising, sales commission, marketing campaigns. Distribution costs. These are costs to deliver the product or service to the customer. Example, transport, delivery vans, warehousing, logistics. Finance costs. These relate to funding the business. Example, bank interest, overdraft charges. These costs are typically not included in inventory. They are treated as period expenses. That means they reduce profit in the period they are incurred. This section explains why we even care about splitting costs into production and non-production. Point 1. It's essential for inventory valuation. Only production costs are included in inventory. Non-production costs are excluded. That affects gross profit. Point 2. It supports decision-making. For example, in pricing, if you understate production cost, you may underprice the product. In outsourcing decisions, you need to know which costs will actually disappear if you stop producing internally, and which costs will stay. Here's a mini example. Factory rent is a production cost. It goes into inventory. Marketing spend is not production. It's expensed immediately. And the final note here links to IAS 2 inventories. IAS 2 says, you can only capitalize costs that are necessary to bring inventory to its present location and condition. That basically means production costs. Selling and admin costs are not allowed to sit in inventory. This is examinable. On this slide, we classify cost in two more ways, by element and by nature. First, by element. We break cost into materials, labor, expenses. This is just describing what the cost actually is. Example, materials could be raw materials. Labor could be factory workers or supervisors. Expenses could be insurance, rent, depreciation. Second, by nature. Here we classify each cost as either direct or indirect. A direct cost is traceable to a single unit or job. Example, would use to make a single table. You know exactly how much wood went into that table. An indirect cost is shared across multiple units, and you can't reasonably trace it to a single unit. Example, factory lighting. You can't say how many pounds of lighting cost went into one table, so you allocate it. This direct versus indirect split becomes the basis for absorption costing, overhead allocation, job costing, and also for responsibility. Here we make it even more explicit with examples. Wages of production staff. This is direct labor. Why? Because you can link those hours directly to units produced. Factory rent. This is an indirect expense. Why? Because the whole factory supports all units, so the cost is shared. Supervisor salary. This is indirect labor. Because supervisors oversee whole areas, not one single unit. You can also extend this logic to services. For example, in a hotel, housekeeping assigned to one specific room clean might be direct for that room night. But the housekeeping manager's salary would be indirect. The exam will often ask you to label individual items direct or indirect and justify why. Next, we move into cost behavior, how costs change when activity changes. This section lists 4 key behaviors. Fixed cost. A fixed cost stays constant in total within a relevant range. For example, rent. If you produce 1,000 units or 2,000 units, total rent for the month is the same. Variable cost. A variable cost changes in direct proportion to activity. If units double, total variable cost roughly doubles. Material cost per unit is a classic example. Semi-variable cost, also called mixed cost. This includes a fixed element plus a variable element. For example, electricity might have a standing charge, fixed part, plus a usage charge per kilowatt-hour, variable part. Step fixed cost. A step cost is fixed over a certain band of activity, but then jumps to a new higher level when you cross capacity. For example, one supervisor can manage up to 10 workers. If you hire an 11th worker, you need a second supervisor, so supervision cost steps up. These definitions drive budgeting, CVP analysis, break-even, and pricing decisions. Now, let's visualize these 4 types of cost behavior using simple graphs. Imagine every mini-graph with the horizontal axis as activity level or units produced, and the vertical axis as total cost. Fixed cost graph. This is a straight horizontal line. Why? Because total fixed cost stays the same no matter how many units you make within the relevant range. Variable cost graph. This is a straight upward-sloping line starting at the origin. Why? Because if you produce 0 units, total variable cost is basically 0, and as units increase, cost increases in a straight line. Semi-variable cost graph. This line starts above the origin and then slopes upward. It starts above 0 because you pay some fixed base cost even if activity is 0. Then it slopes upward because there's also a variable element. Step fixed cost graph. This looks like a staircase. It's flat for a while, then jumps up, then flat again, then jumps again. That shows capacity limits and the cost of adding extra layers of resources, like extra supervisors, extra machines, extra vans. In the exam, you may be asked to identify the correct graph shape from a description. Now we move to cost estimation using the high-low method. This is used to split a semi-variable cost into its fixed part and its variable part. Step 1. Identify the highest and lowest activity levels. Important. We match cost at the highest activity and cost at the lowest activity. Step 2. Calculate variable cost per unit using the difference formula. Variable cost per unit equals cost at high activity minus cost at low activity, divided by units at high activity minus units at low activity. In words, VC per unit equals cost high minus cost low, divided by units high minus units low. Step 3. Once we know the variable cost per unit, we can find the fixed cost. Fixed cost equals total cost minus variable cost per unit times units. So the logic is, strip out the variable portion from total, and whatever is left must be the fixed element. This method is simple, fast, and heavily tested. This section explains why high-low is useful and why it's also risky. Advantages. It's quick and easy to apply. It's simple to understand and calculate. It's helpful for early-stage budgeting when you just need an estimate. Disadvantages. It only uses 2 data points, the highest and the lowest. It ignores all other data. If either of those 2 points is abnormal, an outlier, your estimate will be wrong. It assumes the relationship between cost and activity is linear, meaning it assumes a straight line behavior. Real life can be more messy, with step costs and discounts. That's exactly how you discuss high or low in an exam, what it does well, and where it can mislead you. This section shows the standard linear cost equation, which you will see again and again. The equation is y equals a plus bx. Here's what each part means. Y is total cost. This is the cost we're trying to predict. A is fixed cost. This is the cost that does not change with activity within the relevant range. B is variable cost per unit. This is how much cost increases for each extra unit of activity. X is the level of activity. For example, number of units produced, number of labor hours, machine hours, or rooms occupied. So, total cost equals fixed cost plus variable cost per unit times activity. This is the mathematical version of what you just did with the high or low method. Here's how the different cost elements combine to form the total cost per unit. We start with direct materials. With 5 square meters at $2.50 per square meter, that gives $12.50 per unit. Next is direct labor. 0.5 hours at $6 per hour. That gives $3 per unit. Then variable overhead. $2 per labor hour. Based on the labor hours used, that gives $1 per unit. Then fixed overhead. $5 per unit. This is fixed production overhead absorbed per unit. When we add those together, we get total production cost of $21.50 per unit. Then we add non-production cost at 20%, which here is shown as $4.30. And that gives total cost of $25.80 per unit. This is exactly how we build up a cost per unit for pricing decisions, quoting, profitability analysis, and so on. Now let's talk about basic costing definitions: cost object, cost unit, and cost center. A cost object is anything we want to measure the cost of. For example, a hotel guest stay. The object is that one stay. A cost unit is the unit of output or service we will cost. For example, one room night. One night in one room is the cost unit. A cost center is a department or function where costs are collected. For example, housekeeping. We total all housekeeping costs in one place, and then we can allocate or charge them onwards. These three terms are heavily used in management accounting. You must know them cold. They show up everywhere later: pricing, profitability, overhead absorption, internal reporting. This section connects cost centers to responsibility accounting. We're now asking, who is responsible for what? We have 4 types of responsibility center. Cost center. The manager is responsible for costs only. Performance is measured by comparing actual cost versus budgeted cost. Example, a production department or maintenance team. Revenue center. The manager is responsible for generating revenue only. Performance is measured using sales revenue or units sold. Example, a regional sales office. Profit center. The manager is responsible for both revenue and costs, so basically profit. Performance is measured using profit, which is revenue minus cost. Example, a hotel outlet, a branch, a store. Investment center. The manager is responsible not only for profit, but also for the assets used to create that profit. Performance is measured using return on investment or residual income. Example, a division or subsidiary company. This hierarchy matters because it shows increasing responsibility. Cost center managers control spend. Investment center managers control strategy. Now, how do we keep track of all these costs in a real business system? We use cost codes. A cost coding system is a structured way of assigning unique codes to costs, departments, or activities so that they can be recorded consistently and analyzed later. This slide explains why organizations use coding systems. Used to categorize and identify costs quickly. Standardize data across departments, so everyone uses the same language. Make data entry easier and reduce posting errors in accounting systems. Support automated cost tracking in software like Sage, SAP, Oracle, etc. Importance: improves accuracy and consistency. Enhances cost control and reporting. Helps compare performance across periods or locations. Supports better budgeting and decision-making. So, in short, Coding makes cost information searchable, trustworthy, and comparable. This section compares different types of coding systems you'll see in practice. Sequential codes. These are just simple running numbers like 0001, 0002, 0003. Very easy to generate, but they don't tell you what the cost is for. Block codes. Here, number ranges are reserved for different categories. For example, 1,000 to 1999 might be materials. 2,000 to 29.99 might be labor. So the number itself already tells you the type of cost. This is great for departmental analysis. Facet codes. These are multi-part codes that include different pieces of information in one string. For example, 0103-045 might mean Region 01, Department 03, Expense Type 045. This is very powerful in large organizations because it lets you slice and drill into cost data in multiple ways. Mnemonic codes. These use letters to make the code meaningful for humans. For example, EXP for expenses, REV for revenue, HR for human resources. Mnemonic codes are easier for staff to recognize quickly when entering or reviewing transactions. The big picture. Sequential is simplest. Block improves structure. Facet gives multidimensional control. Mnemonic improves human readability. That's the link between accounting theory and real ERP systems. Let's quickly recap what we learned in Chapter 2, Cost Classification. We started by understanding how costs can be grouped by function, nature, and behavior. That helps us separate production from non-production costs, direct from indirect, and fixed from variable. Then we saw how cost behavior is key for budgeting, pricing, and forecasting. We explored cost objects, units, and centers, which help track and assign costs accurately. And we connected that to responsibility centers, where managers are held accountable for costs, profits, or investments. We also covered cost coding systems, which bring order and consistency to financial data. And finally, we applied the high-low method and the equation y equals a plus bx to split total costs into fixed and variable parts for better forecasting. That wraps up Chapter 2. If you found this session useful, give it a like and share it with other ACCA students. And if you'd like to keep learning chapter by chapter with simple, exam-focused lessons, subscribe. It really helps us keep creating more content for you. Thanks for watching, and I'll see you in the next chapter.